Hello, fellow Rebel Capitalists, Substack subscribers. Hope you guys are doing really, really well. Week off last week because I was in St. Bart's trying to educate myself even further on not necessarily the global macro stuff or the monetary system, because I'm pretty good at that, but more so the trading stuff and how to apply the knowledge and more actionable things for the portfolio to generate alpha, as they say. So it's always a great time. It's always great to get these ideas and talk to really smart people. Give yourself a little bit different perspective on the global macro ideas that you have and how to implement them into a portfolio to actually get that ROI. But anyway, the big news of last week, in my view, of course, I'm all about the labor market, is the non-farm payroll. So let me do the screen share. And we're going to go over to the Market Watch calendar because it's so weird right now because you have this bifurcation of inflation or inflation arguments, which include, well, what's happening in Iran, of course, and AI CapEx spend, deficit spending by governments. And I understand all that. But I believe that, and maybe this is just my bearish bias. Let's go over here. But I believe that's masking a lot of the weakness that's in the real economy, to where people, it's just like out of sight, out of mind. And because we've been so fixated on the AI CapEx spend, on, let's just say, government deficit, fiscal, and in addition to that, what's happening in the Middle East, and that being, I guess you can argue whether that's temporary inflation or leads to longer term sustained increases in consumer prices. I would be on in the camp of the latter, or no, I would be in the camp of the former, the first one. But the main point there is it just seems like nobody's talking about this. And so we go through here Monday. This is August 3rd. You get construction spending, which is a negative, and the median forecast is 0.3. And I know that after the fact, people say, oh, well, it was a negative because of X, Y, and Z. And I get that, but okay, why was that not baked into the forecast? That's always my question, right? Whenever you get one of these big misses and they try to explain it away, and you get factory orders at a negative 0.3, which isn't as bad as last month, but it's still a negative number, and the expectation was for 0.3, a positive 0.3. You get jolts at expectation. ADP was a garbage number, 44,000. And again, if I'm looking at one thing to try to time this, and I actually learned of another thing too. Actually, while I'm doing this, guys, let me grab my legal pad because I had it written down. I don't want to forget this. Because so many of the people that subscribe to my channel, or whether it's the Substack or the Rebel Capitalist Pro, they tend to be bearish because I tend to be bearish. At least, I think it's reality. I don't care. I don't really wake up in the morning and say, what can I be bearish about? It's really, for me, it's just everything looks bearish right now. But at times I'm totally open to being extremely bullish. And then I also think it's much, much different to be bullish on the stock market or a specific stock or the housing market, and then being bearish or bullish on the economy. We have to completely compartmentalize those two views. But I've got it right here, so I'll circle back and give another timing kind of mechanism. But I've always said, looking at a bunch of indicators, the best indicator that I can see as to where you actually get an economic contraction, which they admit to, the NBER, is really all about the labor market. Because even if you get negative GDP and you don't get a labor market that's blowing up, they're not going to admit to it. So it's got to be combined there. And if you do get a labor market that's blowing up, what are the chances you get negative GDP? Probably pretty high, pretty high. So I'm not saying that these numbers show the labor market is blowing up. My goodness gracious, I don't know how you can argue that it's not weak, other than just this kind of tired argument that I get. Well, everyone's moving back to Venezuela, so we don't have to have as many jobs. What? I, 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 as if those people that are working or were working, as if those people didn't spend money. I mean, you got to think about that. Take it to an extreme. Assume we have 350 million people in the United States. Let's just assume the labor market is 300 million. If 250 million of those people went back to Venezuela or just left the United States, and we lost that many jobs or that many working adults, what would happen to the economy? It would plummet. Well, okay, great. I agree. But what would happen to the unemployment rate? Probably not much, because yes, you would have that many people, or that many people would not be working that were working before, but that many people are leaving the labor market. So if that if those 250 million people leave the labor market and the jobs decrease by 250 million, it's not really going to impact, theoretically, it's not going to impact the numbers, the headline numbers that you see. So is anyone going to argue that if unemployment didn't spike, if 250 million people leave the labor market, that's not going to have a negative impact on GDP? Like, no one would say that. For some reason, when it's, instead of millions of people, when it's hundreds of thousands, then it's just like a nothing burger. I don't. Anyway, let's get back to it here. So you look at the initial jobless claims. I think that's really the one thing that I would focus on, because I just don't think there's an argument the labor market is strong. I don't think there's an argument really that it's anything other than really, really weak. I think the only thing you can latch on to are the initial jobless claims. And it is true that when you have an economic contraction, if you go back in time and look at the jobless, they always spike. So maybe that's what you do. You just focus on how bad the labor market is, but understand that it's not going to give you any type of actionable advice or insights until the jobless claims go up so significantly, not to just 220 or something like that, but go to 300, 350 plus. And then you've got, and productivity is up, that's good, but you've got the unemployment report here, negative 23,000. I've done it many times on these videos where I go back and look at the negative non-farm payroll numbers, going back to the 1960s, 1970s. And it's very rare that you get multiple negative non-farm payrolls. And by the way, another thing that we have to think about is Trump's been in office for, a year and a half plus. So at a certain point, it can't be about immigration forever, right? It can't be about sending Venezuelans back to Venezuela or El Salvador or whatever the hell, it can't be about negative net migration or whatever it can't be that forever, right? At some point, all the people that are going to go back home have gone back home. And the negative non-farm payrolls have to matter again. And in my view, they've always mattered for the reasons I just discussed. But you get a negative 23,000, and again, expectation 83,000. And last month you had 20, which is a garbage number in and of itself. And then the unemployment rate goes down, and just because the unemployment rate goes down, people are like, well, no big deal. Whistling right by the graveyard, thinking that this is the be-all, end-all. But in reality, you actually just think about it for a moment. I don't know how it's not about the number of people working, which, and people just assume that the 4.1 is just like a derivative of how many people are working. That's not true. Like, again, you have 250 million people leave the job market, and yeah, you could have the unemployment rate stay the same, but that that doesn't tell you anything about the labor market or, by the way, the underlying fundamentals of the economy. So the reason this went down is just because you had more and more and more people that are actually leaving the labor market. And I don't know how that's bullish, right? Like, if you had labor force participation increasing and this number going down, and then this non-farm payroll was 300,000, 400,000 on the plus side, yeah, I get it. Then that's fantastic news. But this is the complete opposite of that. Hourly wages, lower than expected. I mean, month over month, lower than expected. The month over month was 0.1. You got a 0.3 was the expectation. Last month was a 0.3. I mean, it's just, this is horrible. This is, with the exception of the initial jobless claims, this is horrible. And so, and by the way, this is massively, massively disinflationary. But for some reason, everyone is just, hyper-focused on an oil price that spiked to 120 2 months ago. And granted, could spike again based on what may or may not happen in the Middle East. That's definitely a concern. So you have to have, I guess, within your interest rate expectation, it's got to be higher than it otherwise would be, just because of the uncertainty with the oil price, and therefore, and not just the oil price, everything that moves through the straits, where you have that supply chain disruption that's happened because of war, really. I guess there's no other way to say it, right? But it just seems to me like for the last 2 months, everyone has just been focused on this shiny object, which is the Middle East and AI CapEx spend. And everyone is just ignoring this and ignoring private credit, which ain't getting any better. It's only getting worse. Now, is that actionable for your portfolio? Not right now. Not right now. Because, based on this alone, would I go out and buy puts in the S&P 500? Absolutely not. Absolutely not. And let's remember, too, a lot of time there's an inverse correlation between the health of the economy and the S&P 500. And, sometimes there is, sometimes there isn't. But what I've seen, especially since really getting into this after I retired in 2012, is a lot of times, the worse people think the economy is going to be, oh yeah, interest rates go down. Oh, well, buy. And the stock market continues to go higher and higher and higher. But I do think since the GFC, the main driver outside of passive and all these, the main driver of the mindset is just this, I would call it irrational bullishness. And the reason I would call it irrational, although it doesn't mean that the market can't continue to go up, is because it contradicts itself all the time. I've seen this so many times just from doing videos, and I got to pay attention to this stuff. And what I mean by that is, right now, the narrative could be, and I'm not saying, this is happening, but I'm just giving you a hypothetical. The narrative could be, oh, well, everyone's got to buy stocks because the Fed's going to lower interest rates. And then 6 months later, when the Fed's talking about hiking rates, you're like, oh, well, everyone's got to buy stocks because the economy is doing better. Right, but they're raising interest rates. So which is it? It's like there's always just some sort of argument that can be made to buy. And when I would consider that irrational is when those arguments contradict the argument they made from just a month prior. That sounds like, wait a minute here. I think you're it seems like you're moving the goalposts a little bit, right? So, But again, timing this with some sort of bearish call, I don't know how you could do that. I'm not good enough to do that. And I think that was one of the main takeaways from the event, the conference that I went to last week in St. Bart's with my good friend Hugh Hendry and a lot of really smart portfolio managers and hedge fund guys and Wall Street types and whatnot, is that, yeah, is the market overvalued? Is it crazy? Yeah, but you don't know when it's going to turn. So again, going back to the labor market, what I would focus on, probably the initial jobless claims. Obviously, I'm going to focus on non-farm payrolls, but not really as a timing mechanism. It's more so telling you what's happening beneath the hood. But this is what I'd look for as far as the timing mechanism. And it's not going to be perfect, but I think and also the unemployment rate, because I think, although mechanically, like I was saying earlier, how it really doesn't matter that much and it's all about the nuance. But I think psychologically for the market participants, that does really impact their decision-making process. So now let's go over to the what's going on in markets. And then I want to circle back to, I don't know if it's an epiphany, but something that I've heard from something that happened last week that led me to discover some insights from some legendary investors that make a lot of sense, but I hadn't thought about before. So that is very, very timing centric as far as the insight. So let's go over to CNBC. Well, and Michael Burry is calling for this, 1987. It's interesting with Burry because he always makes these headlines, but I actually subscribe to his Substack, which is right here. And, he does what I do kind of on Rebel Capitalist Pro, where if I'm going to do something, I just do a post on it. If I'm going to add or I'm going to sell something or add something. But he's got a lot of long positions. So, I mean, he makes headlines for just his bearish calls, but if you actually look at his portfolio, it ain't that bearish. I mean, I guess it fluctuates, but he does have some shorts. But he's got, like I said, it's got a lot of long positions as well. So anyway, let's go back over to just what's going on. So, I mean, S&P probably at an all-time high, right, guys? Yeah, look at that. Yep. Really broke out. My goodness, that's when I was in St. Bart's. I don't really look at charts because I'm more so focused on what the guys and gals there are saying and kind of the ideas they're discussing and whatnot. So I'm really not paying attention to markets. I didn't realize it had this much of a breakout. That's a good looking chart. I mean, are we in a bubble? Absolutely. Are things wildly overvalued? Absolutely. But the number one rule in trading or investing, Marty Zweig from 1990, 1991. Number one rule, trend is your friend. We talk about that in Rebel Capitalist Pro all the time, all the time. And the chart looks good. That doesn't mean that I'd be outright long, but you can't deny the reality there. I mean, it makes you want to vomit, right? Not to be crude, but it's just like, everyone knows. Everyone watching this, I'm sure, knows this is just an absurd, obscene bubble. But it's still likely going higher. And again, I want to be very clear, not investing advice. I do have a long position, just full disclosure, in the S&P 500, but it's a hedge. It's a hedge against my short positions. So there's no way I would take an outright long position in the S&P 500 right now. Okay, let's go over to something that I think is a little more interesting, just as far as a directional bet, and that would be gold, because I'm pretty sure you're getting some higher highs and higher lows there. Yeah, yeah, yeah. So this is a 1-year chart. So this to me is really interesting as far as just, kind of a directional long bet in gold. And remember, for those of you who don't watch a lot of my videos, I always have a position in gold. It's more of an insurance position. But when I talk about the price of gold going up or down, that would be if you're buying or selling gold as a speculation. And so if I'm speculating, I might probably, let me see here. I mean, I might wait for a little pullback or might take a small position now. Not investing advice, and I haven't done that, to be clear. And if I was going to do that, it would probably be in the miners. In fact, let me look at that really quick. So, what's the gold mining ETF? You guys probably know that better than I do. Is it GDX? I'm just going to look at my phone because I've got it on my watch list. Bear with me, guys. Sorry about that. I'm just curious what the chart looks like. Yeah, I believe it's GDX because the juniors are GDXJ. So let's do. Yeah. Yeah, I mean that actually that's tempting. Hmm. That is tempting. So for me, this is probably just from like an actionable portfolio setup standpoint. What is one of the things I'll definitely be watching next week, because I don't like to buy things when they're in a downtrend like this, even if I'm bullish on it. You see how it's just lower lows, lower highs. That's like you're just trying to catch a falling knife, and I'm nowhere near good enough to pick the top or the bottom or anything like that. So, yeah, I like it when you're getting some high. You got this low, down, 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 and then boom, you get some higher highs and higher lows, and to me that's what I like to see. As an example, right now I would be bullish, like the 30-year Treasury, because I have never seen in my life any asset that is more hated than the 30-year Treasury right now. I mean, people just think it's going straight to 15%. But so, I've got that macro view, but when you look at the chart, you're like, I don't know. Looks like, I mean, you're getting higher highs and higher lows. It looks like a trend upward. And so this is something where I've got a view as though there's going to be downward pressure on rates, simply because all the people that have sold have probably sold, right? Because everyone's so bearish on it. But I'd wait for a couple lower lows, because again, as you guys know, inverse relationship between the price and the yield. So lower lows, lower highs would be the price going up, not down, because we're talking about the yields. So I would look for some lower lows and lower highs in the yields. And then if it broke back down below 5, I'd probably, maybe even 5.1 or so, I'd probably take a position there. But I don't want to get too far sidetracked. So let's get back to the CNBC homepage. I'm assuming silver has a similar chart to gold. Yeah, it definitely bounced a little bit. Yeah. I mean, just due to my macro kind of bearishness on the economy, I'd probably, if I'm going to speculate, I'd rather do it in the gold miners. than silver. Where were we here? Okay, that's it. Bitcoin's bouncing as well. Uh, yeah, yeah, yeah. I'm gonna go for. If I got to choose between gold and Bitcoin, just based on the charts, uh, gold. And if I got to choose one thing, I'd probably do the miners there. Miners look pretty good. Okay, now let's go over kind of a timing mechanism that makes a lot of sense, but I'd never thought of. So one of the things that we did at Hughes conference, summer camp, whatever you want to call it, is Steve, the guy I call Steve, was just such a great guy. I would consider one of my best friends. And he had some clips from Stan Druckenmiller, and then he was commenting on these clips. So it got me thinking, and I watched many, many, many videos on the flight back of Druckenmiller and Paul Tudor Jones. And one of the things that I heard them both say, as far as timing a downturn in the stock market, is the issuance of more equities. I mean, it makes sense, right? When it's just like when there's money being created, you're going to get inflation. I don't think the Fed really prints the money, as you guys know. I think the commercial banks. But bottom line is, if you're creating more currency units, then it's likely that the value of those currency units goes down. And so they said in their experience, whether it's whatever bubble it is in equities, it's usually the timing as far as on the way down correlates with the amount of issuance. So you just have massive supply hit the market, and the market kind of gets to a point where it pukes it up, and then you get into the right-hand side of the Christmas tree of death, which is the way the chart looks. My buddy Ben Bray kind of coined that phrase when I was talking to him the other day. So that's really what I'm going to be looking for. Now, there is no way, like I said, that I would take an outright short position in the S&P 500 right now. But what would get me thinking about it, I've got to do some research this week, is if issuance really starts to ramp up, which we've seen, right? With a lot of the hyperscalers having to sell or talking about selling equity to fund AI CapEx spend. When you get all these IPOs like SpaceX, we'll see about Anthropic and OpenAI, that's just issuing more and more shares into the market, where not too many people know this, but if you look at going back to the GFC, one of the things that really boosted the stock market is just all these buybacks. So you're just reducing supply. So if you have that turn and now all of a sudden you're increasing supply tremendously, that could be kind of the straw that breaks the camel's back. And like I said, that was straight from Tudor Jones. That was straight from Stan Druckenmiller himself. And another thing that I kind of learned by watching all those videos from those guys is you think they're just towering intellects. But if you really get down into the nitty gritty, most of their kind of theories on how the market works, or kind of these timing, it's pretty commonsensical. It's pretty common sense. In fact, I was just listening to an interview with Stan Druckenmiller. It was maybe a year old or whatever. And he was talking about how he made all of this money buying these producers of the weight loss drugs or whatever they were. And the guy, the interviewer, asked him, how did you do that? Like, how did you figure that out? And, he was expecting this super in-depth answer, with all this research and, quantum physics and math and whatnot. And Druckenmiller's like, have you ever been to Disney World? He's like, go to Disney World in the U.S. Everybody's fat. So You got a weight loss drug? I'm going to buy it. And that was basically the extent of his analysis. So one of the things that I really learned from the conference, and also from just binging on these videos from Druckenmiller and Paul Tudor Jones, at the end of the day, don't overthink it. Some of the stuff can get very complex, but some of the stuff is just super, super simple. And like Jim Rogers says, just wait till you see a pile of money sitting in the corner. And when you do, just go pick it up. I think sometimes, I get that way. Like if I have an idea and it's not complex enough, I just assume that there's no way it'll work because it's too obvious, when in reality, those are the ones that I should probably be pulling the trigger on. All right, guys, enjoy the rest of your weekend. As always, make sure you're standing up for freedom, liberty, free market capitalism. We'll see you in the next video.